Morning, welcome to Ainsley News. This Thursday, what another crazy night for gold and silver. Of course, we're going to talk more about that just now. Why are gold and silver surging? After another very strong night in the Northern Hemisphere last night, gold at $1,872 or $1,872 is just $30 off an all-time high of $1,900, while silver smashed through $23 to a 7-year high, but still less than half of its US $48 high in 2011. And the GSR sits at 81. In Aussie terms, gold is back above $2,600 and is now $120 off the 2,745 all-time high in March this year. And silver at $32.40 Australian and is more than $10 off its 2011 high. So why all of a sudden are things ramping up again? The list is extensive and it is about as much about the sum of the parts as any individual one because nothing is particularly new. However, rarely do we have an environment where nearly all financial experts are almost unanimously bullish gold. Firstly, currency debasement. Just yesterday, Deutsche Bank Jim Reed concluded gold is definitely a fiat money hedge after stating fiat money will be passing a fad in the long-term history of money. Reed pointed out that from 1860 to the end of the gold standard in 1971, the real price of gold fell 75% against inflation. Since we left the gold standard and embraced fiat currency to now, gold has risen 700%, double its 1860 real level. What is happening now is an unprecedented, and dare we say terminal death row, debasement of fiat currencies around the world through central bank money stimulus and government deficit spending. Today we see headlines in Australia stating a child born today will not see the current COVID-19 deficit spending repaid before they are 30 years old. And that is before the inevitable extensions of various support packages, as this gets worse, not better. Whilst we discussed yesterday of the RBA doggedly resisting more stimulus, we are seeing elsewhere in the world a new surge in negative yielding government bonds. This next chart here is showing the global negative yielding bonds since around 2017 to 2020. The chart alone is very bullish for gold as the prices very closely track this chart. It also highlights the level of debasement when we have over 14 trillion of negative yielding bonds in the world at the same time as fiat currency being created at an unprecedented pace. In real terms, deducting inflation, US 5-year treasuries are already negative, now yielding negative 1.15%, a 7-year low. And as we've shared before, the trend is most definitely lower. Many economists are predicting we will see negative unadjusted yields in the not too distant future. That sees big money querying why they'd take on the risk of money in the bank when there's literally no return for that risk. As treasuries become zero bound, that same money is becoming more wary of treasuries and the capital growth potential to offset that lack of yield, leaving gold and silver as the sole safe haven trade, with strong capital growth potential and the added benefit of no counterparty risk. As we discussed yesterday as well, we now have the EU in a coordinated and massive stimulus package, half of which is not even pretending to be debt, instead an outright grant to the struggling economies. That is outright pure, eyes rolled back money printing. This all collectively sees downward pressure on the USD too, which is now at its lowest level since the March mania, and again bullish for gold and silver. In summary, from Bloomberg, the combination of low to negative government bond yields plus a weakening US dollar, and most importantly massive central bank accommodation, supports financial demand, said Stephanie Monier, Chief Investment Officer at Geneva-based bank Lombard Odier and CSA. This relationship between gold and real yields has held for the last decade, and recent central bank interventions have reinforced the case for holding gold as a portfolio diversification tool. Next point in case is China. Last night's precious metals rally was certainly further fueled by the escalating tensions between the world's two biggest economic superpowers. The closure of the Chinese embassy in Houston is just the latest incident in tensions ranging from technology, Hong Kong politics to trade. Whilst initially spooked, Wall Street shrugged it off with new vaccine hopes again, and shares rallied again, but there were plenty heading for cover in precious metals and treasuries. Michael Every, head of Asia Financial Markets Research at Rabobank in Hong Kong, summed up this complacency well last night in Bloomberg. This is only the latest escalation in a series that will end up in a crash for relations for Hong Kong and for the yuan unless something changes. The markets will worry for all of 5 minutes and then resume rallying right up until they realize the China-US dynamic blows everything up eventually. I'm massively bearish in the long term, so enjoy the ride and don't believe in it for a moment. The China issues go well beyond the US tensions too. We passed on Crescat's excellent summary of the woes before China right now, earlier this month. Aside from the political tensions, we also have the fact that China too is seeing the effects of the global recession, whilst carrying the biggest debt burden in the world. Bloomberg explains in the article, as China's economy slows, why the world should care. China's $14 trillion economy, second only in size to the US, accounts for almost a third of global growth each year. That makes it a vital driver of job creation and improved living standards everywhere. The advanced age of the US expansion, more than a decade, and worries about Europe make China's pace of continued growth that much more important. If China's current slowdown were to suddenly accelerate, the ripple effects would squelch the global recovery. A slowdown is structural, something that's expected to happen over time, but a plunge defies expectation and is therefore far more disruptive. Last week, China surprised analysts with a better than expected GDP print for the second quarter, April to June, of 3.2%. Those that even believe the numbers that China puts out also qualified this was likely pent-up demand of outstanding orders held up by the lockdowns, and so universally doubt China's claim of a bigger bounce back towards 6% from here. This, of course, followed the negative 6.8 print for the first quarter. However, even 6%, if achieved, is not as amazing as it seems. How come? Bloomberg go on. In one respect, nothing, since it's more than twice the global rate. But China's economy is loaded up on debt, and its ability to service repayments depends on rapid growth to generate the profits and tax revenues needed. Slower growth challenges China's ability to stem the build-up of its government, corporate, and household debt, which, according to Bloomberg Economics, is on track to add up to more than 300% of gross domestic product by 2022. The bigger that debt pile becomes, the bigger the impact on global growth, should it all go sour. Plus, growth could even slip below 6% without more aggressive stimulus, something officials in Beijing have been leery of trying for fear of sparking a financial blow-up. Falling China demand will be a huge weight on our AUD, adding to any USD gains in gold because of the impacts on the global economy. Finally, as explained in part yesterday, there has been a lot of money in the sidelines waiting to see clear signals that silver's bear run since 2011 was actually over, and we've discussed this before. That money appears to be convinced and is now pouring in. As the GSR drops towards its mean of around 45 to 50, we could expect to see this continue strongly, though not without its peaks and troughs along the way, that this much smaller and volatile market routinely dishes up. Bull markets are not uncoincidentally named after the bucking beast. We hope you enjoy the ride. Thanks for joining us for news today. Jump over to ainsleyBullion.com.au for everything gold and silver. And if you're interested in cryptocurrency, ainsleywealth.com.au. We'll catch you tomorrow.